Welcome everybody to Banana Bread Trades. My name is Goose and welcome to the world of futures trading. If you are new to this side of the stock market, you have came to the right place because in this video, we're going to go over everything that you are going to need to know to get started on your futures journey. And here's a little look at today's overview and what we'll be talking about in this video. We'll be talking about everything from the basics of, what are futures, the types of futures there are, what I trade, and the dangers and risks involved that come with trading this side of the stock market. Then we'll move a little further and talk about brokers, how much money you need to actually trade futures and the time required, and how to kind of get all that set up. We'll move a little further and talk about the actual trading itself and get you set up with some charting platforms and again, brokers and data that goes with those charting platforms and how to get those set up. We'll move a little further into that with the actual strategies and trading part itself. I'm going to lay out a roadmap for you to further educate yourself and build those tools that I think are actually important to being a good trader, because there is a lot of information out there and not all of it is good information. So I want to give you guys a base to be able to know what you need to know to actually be a successful trader. And that's what's going to be outlined in this video. So here's the big question. What are futures? What is the futures market? Well, a futures contract is just a type of contract to buy or sell a specific commodity, security, or asset at a future date for a specific price. The futures contracts are very similar in theory to an options contract where there's a buyer or seller. But the difference is in options, there's a right to buy, which means if it doesn't reach the target, then the contract expires worthless. Whereas in futures, you are obligated to buy, which means at expiration, whether it is for a loss or a gain, you will be delivering or receiving what is ever in the underlying contract. Now, us as traders, we're not holding into expiration with a futures trade unless you are, a big firm or farmer, depending on the type of futures you are trading. So we don't worry about that. We are just worried about trading the difference in value of these contracts. But the valuation is going to be a lot different than that of an options contract, and we'll get into that a little later. The process of doing so is very similar to that of what we would be doing with just regular stocks. You're placing a limit or a market order, you're looking at candlestick charts. The whole buy-sell process is almost exactly the same as you would be doing on Robinhood, buying and selling stocks. Now that we know what a futures contract is, we can talk about the types of futures markets there are to trade. In the commodities or energy, currencies, equities, there's a large spectrum of things that you can find that really suit your style or what you really enjoy trading. In the commodity spectrum, there's, corn, lean hogs, or gold and silver, things you can hold. Then there's the equity index, which is where I spend a lot of my time trading futures on the NASDAQ and the S&P 500. A lot of people like spending time in the energy sector where they trade futures on oil and natural gas. And there's still some people out there that trade currency futures, which is more of like in the Forex realm or even Bitcoin realm, in which that futures is relatively new to the market. But like I said, I spend most of my time in the equity index and I dabble a little bit in the commodity world as well. Okay, so I know what a futures contract is, and I know that there's a broad spectrum of, different things we can trade, but I don't understand the concept of why we would do it, right? So let's go over a couple examples here of what a futures contract actually entails and why it's valuable. You can understand while you're trading what that value really means. So let's do a commodities example here where we are Farmer Steve and we're going to be trading corn futures, okay? Corn is currently trading at price X and we're a farmer, right? And we think the price of corn is going to drop by the time we're ready to harvest. So we're going to sell a futures contract with the obligation to sell 5,000 bushels of corn for the current price of X at the contract's expiration date. This guarantees that we will get this price when harvest comes, and we will be safe from any sort of price drop. Therefore, we can actually net more profit, and we are guaranteed to get this price. Now, let's say we're an ethanol plant, right? And this is the example on the right here. We're an ethanol plant, and corn is currently trading at price X. But we think that by the time we are ready to buy more corn, the price is going to increase. So we buy a futures contract with the obligation to buy 5,000 bushels of corn for the current price of X at the contract's expiration date. This guarantees that we get this price when it comes time to buy corn. And if price does increase, we have avoided buying corn at those higher prices. So we don't really want to buy corn or sell corn as traders, though, do we? We just want to trade the value of the fluctuations in these contracts' prices before the expiration date. We will not be holding contracts into their expiration unless you really just want 5,000 bushels of corn. I mean, if you want, that's completely on you. But really, as traders, we just want the difference in contract value as price is moving around, not the actual 5,000 bushels of corn. So now we got an understanding of what futures are and why they're valuable, yada, yada, yada. Why should we trade them? Why do we trade futures instead of just regular stocks and options? Well, the reason I enjoy it is mostly because the leverage and liquidity in the futures market. If you select the right thing, like I like trading the NASDAQ and S&P 500 futures, the margin required versus the potential gain in a given day is a very good ratio. This can be good and dangerous at the same time, which means there's a lot of opportunity to make a lot of money relatively easy, but you can also lose a lot of money relatively easy, right? There's a lot of volatility and a lot of money being thrown around in a given day. So that's why us as traders need to hone our abilities and our skill sets to be the best trader and as accurate as possible. The next reason I love trading futures is time, right? There's a lot of different markets in the futures realm that are open 24 hours a day, 5 days a week. And this allows you to trade when it's convenient for you, because a lot of people, especially if you live in the US, work a 9 to 5. And when is the market open? Usually when you're at work, right? Well, with futures, you can choose to trade after work, before work. Heck, if you want to trade midnight to 2 o'clock, right? You can trade that time. And futures allows you to be more selective with what works best for you. Now, the volatility throughout the day may change, right? The volatility at nighttime is going to be a little less than it would be during regular trading hours, but you can still specialize and be profitable in those times because the market is open. And finally, in futures, there is no pattern day trader rule. And if you've been trading for a while on a small account, you'll notice that, oh, hey, I'm only allowed 3 intraday trades per week. That's kind of dumb. Well, in futures, you can trade as many times as you want on your small account as long as you fit the margin requirements, which are, in the futures world, pretty small. So you can trade a $2,000 account as many times as you want, as long as you're over the amount they say you have to be, which is really low. That's what I was saying. You don't have to have a lot of leverage in the futures market to make a lot of money, and we'll talk about that here a little later on. But before we do, futures trading is dangerous, right? The leverage requirements, as I've been saying, are very lenient, and you can make a lot of money with not a lot of money, but you can also lose a lot of money. And because of how futures are and the obligation to buy contracts, your account can go negative. Now, most brokerages will stop and liquidate, your positions before your account goes negative. That's why there are margin requirements, but that doesn't always work. Sometimes there's slippage or news events, and you are not always completely protected from having that go negative. So you have to keep the amount you're trading and your leverage in check so that if there is some sort of event or something happens, you will not get financially ruined. It is dangerous. I've seen it happen. So you need to have education, and you can't just hop into this without knowing what you're doing, because it can really ruin you financially. I just want to make that clear. Futures trading is dangerous. Know what you're doing. You can go negative, right? A futures contract goes down. It doesn't just go to zero in value. Your account keeps going down, right? It's weighted just a little differently than stocks. So be aware. It's dangerous. Be careful. Okay, next slide. So getting started. Brokers and margin requirements. What is a broker? We'll go ahead and cover that first. They manage the buying and selling of your contracts. You put your money in a brokerage account, and when you place a trade, they use that money to buy and sell your contracts, right? Now, margin is what these brokers require you to have in your account before trading. And there's 3 types of margin that you need to be aware of. There's initial margin, which is the amount needed to initiate a trading position. There's maintenance margin, the amount needed to maintain that position. So let's say you're holding a position, you need to at least have this much in your account as it's going up and down to secure, this keeps you safe and keeps the brokerage safe in case some wild thing happens. And then there's day margin. Now, day margin is what us as day traders mostly focus on. And this is a reduced margin for trading just between the open and closing hours of whatever futures market we are trading. And this is reduced because they are factoring in the amount that, the stock can move within the day, and that they can for sure keep themselves and you protected. Now, this picture here is from the AMP futures broker, and this is their margin requirements. So if you are just day trading, your margin requirements for trading an E-mini S&P 500 contract is only $400. That's all you need in your account to initiate that trade. And that maintenance margin you see, that's if you want to hold the trade overnight, right? You want to hold it through market close into market open for multiple days. You need to have at least $10,600 in your account. And that protects them from any sort of liquidity spikes that happen in between open and close. But like I said, if you're just trading in the day, you just have to have $400 in your account. Now, if you have only $400 in your account, and let's say you place a trade and your account drops to, $399.99, you're going to get liquidated, right? They have those protections in place. They're going to try to liquidate you as soon as you drop below 400. So you need to have probably more than 400, but you have to have at least 400 to initiate that trade. So yeah, it does kind of require quite a bit of money to actually get started trading futures if you want to do it effectively with higher leverage. And there are ways around this. There are this thing called proprietary firms, or prop firms for short. And this is a company that's going to provide traders with capital to trade with in return for percentage of the profits. And all you have to do is pass an evaluation that they give you to prove that you can make money consistently and hit certain profit target and follow certain rules. Then they will give you that account. And what's really great for trading on these prop firms is that you're not liable for losses in that account, right? Always read the fine print. There might be some out there that are sketchy, but for most of them, if you lose their money, you're going to be financially okay, right? If you lose $2,000, $5,000 in their account, you lost their money, not yours. And all you're going to be out is the cost that it took you to do the evaluation. They give you a test and it costs you money to do this test. And then they cost you money to set up your funded account, right? So if you're trading with Apex Trader, for example, and you want to trade their 50K account, that's going to be about, without the discounts or anything, I think it's like $130 to do the evaluation. And then to set up your account, it's going to be another $150. So in that account, though, you get $2,500 worth of money that you can lose, right? It's a $50,000 account, but they give you a buffer. They're like, hey, just don't lose this much of our money. So you actually get $2,500 worth of money that you can trade with, and it only costs you $300. So if you blow the whole account, right, you lose the $2,500, you actually only lost $300 of your own dollars. So you're only out $300 and you actually lost $2,500. So that's a great deal, especially for people that are new. And if you're learning to understand futures, I think it's a great opportunity for you to trade with something on the line, but also not put yourself at any substantial financial risk. And like I said, I trade with a prop firm. I trade with Apex, and they allow you to have multiple accounts. So you can trade at relatively low leverage, spread that out across all the accounts, and actually make pretty good money. And I really enjoy it because I am not at any real financial risk besides what I put in to pass those evaluations. Okay, but like, how do we actually like trade? Like, what do we use to actually make the trades? Well, we have loads of options. There are hundreds of different charting platforms out there. I put some of the main ones here on the thing with the stuff. I trade with Quantower. That is my current choice. I will probably eventually be moving to Sierra Chart. The problem with Sierra Chart is you have to be just an absolute unit of a coding human being to understand how to use that platform, but it has a lot of potential. Quantower, however, does everything I need it to do, and it's really simple to use, so I enjoy using it. But if you're doing a lot of back testing and you're good at coding, I would suggest Sierra Chart. There's some others out here. Tradeovate's really easy to use. It's maybe not the best in terms of reliability as far as the data goes, but you know, the platform itself, very easy. A lot of beginners, like if you're a beginner trader, Tradeovate or Quantower, both really easy, and you know, will give you what you need to get started. I like Quantower just for the fact that their look back data, like if you want to do some historical, you know, searching and whatnot, it's going to be a lot better than Tradeovate. That's why I use Quantower, but I'm not a coding genius, so I do not use Sierra Charts. And again, there's some other ones in here as well. You can use, you know, do your research on all these, kind of figure out what works well for you. If you're using a prop firm, you know, some prop firms will supply you with a trading platform. They're like, hey, use this one. It works best with our data provider, or whatever broker you decide to use, you know, depending on where you're watching. Some countries have different brokers. They will also supply you with like, hey, we work best with this charting platform. So it really depends on, you know, what you're doing, what charting platform you'll use. But, you know, most of them work with everything. Just find one that really suits you and has what you want it to do. And now we have data providers. Now we have a charting platform. That charting platform needs the actual trade data. Those trades that are happening need sent to that platform so it can then chart them for you. And that's what is on your screen right now. Is there's a whole bunch of different data providers. There's hundreds of them. And it really depends on what prop firm or broker you are using. They will have a set of data providers that work best with them. And then based on that data provider, you can then select a charting platform that works best with that provider, or whoever your broker or prop firm, whoever they set you up with. But just so you know, there's kind of like a weird process of things that happens. It's a little confusing if you're new to it. But yeah, you have a broker, and then that broker is going to say, hey, we want you to use this data provider. And then with that data provider, these charting platforms work best. Okay, this sounds like a lot. I'm confused. What all do I need, and what's it all going to cost me? Okay. Well, what I use is I use AMP Futures as a brokerage account. And what it costs me to have them is I need to maintain at least $100 in my account, and there's no other fees. So as long as I have $100 in my AMP Futures account, I'm good. And then what do I use for a charting platform? Well, I use Quantower, and all the features for Quantower are free as long as I use an AMP Futures account. So as long as my brokerage is AMP, I have all the settings and features on Quantower for free. And that's why I chose AMP, as a broker because they had that deal. Now, I have to have data provided to my charting platform, and AMP works really well with CQG. So I use CQG as my data provider, and that costs me $13 a month to have that data provided to my charting platform. And the data that I'm getting is for the ES, NQ, RTY, and YM. Now, again, prop firms will normally give you a choice of platform, and your data fees are going to be included in your subscription or setup fee. You're not going to have to worry about choosing a data provider. A prop firm will set all that up for you and just include that in whatever your eval cost is. All right, now that we have a really good idea on futures, what they are, the platforms, everything to get to the trading, now I need to talk about the trades themselves and what kind of you're going to need to further your education to find those things that are going to give you a statistical edge and an idea of, what way the market's going to grow. And one of the hardest things for a new trader to do is find reliable information. And you'll notice on the internet, there is a lot of garbage dog shit information out there. A lot of people don't know what they're doing, and they tell you these weird indicator theories. They're like, oh, just trade, take a long when MACD crosses an EMA, and, this other thing over here does this, and the guy crosses the road, and then you go short. The market's more complicated than that, and it changes week to week, month to month, quarter to quarter, election cycles, all this different stuff. It's a lot more complicated than just trading because an indicator crossed another indicator, right? And to put it simply, the market is an auction process, right? And that auction process is going to change a lot. The volume's going to change. The volatility is going to change. We're going to go from bull market to bear market. Some of those strategies with indicators, they might work for a certain market condition. But us as traders need to be versatile in identifying what market condition we're in and how we can give ourselves a statistical advantage to trade in every market condition, or at least be able to identify when it's in a different one and when we should stay flat. So there's a plethora of information out there, and I'm going to give you kind of just a brief overview roadmap of where you should at least get started, right? And from there, you may develop your own theories and everything and your own strategy, and I encourage that. But there are some real basics that you should learn, and they're lined out right here on the screen. And like I said, the biggest thing you should learn is auction theory. There's a lot of different ways we can break down auction theory, but really just the premise of it is the philosophy that markets are going to move up and down based on the imbalances and buyer and seller aggression, right? What are prices that are so low, people are no longer willing to sell their shares because it's too good of an opportunity to buy. And when our price is so high that people are no longer willing to buy those prices, right? So that's the kind of the premise of auction market theory. And this kind of breaks out into a bunch of reasons why that works and how we can identify what it's doing to better make ourselves aware and make trades based on the information that's being given to us. Two relatively basic things from auction theory that we'll have are news events and then ideal trading hours. These are on opposite sides, but things you should really learn. You should learn the events that are going to affect the market, the news events, right? FOMC, CPI, jobless claims, non-farm payrolls. Learn all the major news events and why they are affecting the market. Why is CPI important? Why is the Fed speaking? What are they going to be saying that's going to affect why we would want to buy or sell our stock? Right, you need to understand these events because they can be relatively volatile. Then you also need to know your ideal trading hours. Markets are open usually 24/7 or 24/5 at least, depending on what you're trading. They might not be open on the weekends. Decide what you want to trade and when you want to trade, and then learn to adapt everything around those hours because the volume of the market and the amount of people trading varies from hour to hour. So you want to understand what hours you're trading and why the hours you're trading are going to be ideal for either volume or just you personally. Up to the top here, we're going to have volume-based knowledge. Again, I've talked a lot about volume, and that's just the amount of people trading and the amount of contracts flowing through at a certain amount of time. And volume can kind of be broken up into a few different things. A good way to see volume would be through volume profile, and I'll put a picture of it up right here. This shows at what price the amount of trades are taking place in a given period of time. Right? So you can select like, okay, I want to see the amount of trades at this price for the last month, or, just this last current daily session. It gives you a really good idea, and you can see the structure. You can see where there's a lot of people buying, where there's not a lot of interest in trades being taken. And there's a lot of different theories around the structure of volume profile to give you like an idea of, okay, well, there's this many people buying here, so market should theoretically move to this place. And there's a lot of different videos. I really encourage you to know volume profile really well. I think it's very important. Another thing would be market structure, and that also goes in with volume profile a little bit. And there's a few different ways you can break down and see market structure a little bit better. That would be with TPO charts. And again, just lots of really good YouTube videos. If you join the Discord, we have some that we like linked in the Discord. Footprint charts, these really just break down what's happening at each price, the buyers, the sellers, the volume, the delta at each price. It just kind of breaks everything down all the way to, each detail at each price in each candle. And then another thing would be support and resistance, or supply and demand, as some people call it. And this is just marking out your levels of where you can see that there are indeed a lot of buyers and sellers at this level, or like maybe there's not a lot of buyers and sellers at this level. And you mark out these levels to indicate where you want to enter or exit a trade, because these are the levels that we are interested, where the market might pivot, right? Where there's a lot of supply, market should pivot there and now move to an area of more demand, vice versa. Now here, moving to the lower half of auction theory, we move into the price action kind of side of things. And it could be argued what the order of this should be. I'm not really set in my ways or die hard. I really just kind of ran out of room on the charts, because some of this stuff you could argue should be in volume-based knowledge, but that's not important. It's just important that you know it. The price action, really, you get to a level, you have some sort of pattern or, shape of the market, or you're following a trend. Price gets to somewhere and starts acting a certain way. That's kind of price action, right? We're looking at how price is moving when it's in this pattern or trend. And we see that better by looking at order flow, or kind of interpret it better by looking at order flow. The DOM, level 2, time and sales. It's just showing all the buys and sells coming through and how they're coming through. You can see the size of them. How big are these orders coming through? It better give you an idea of like, hey, there's a lot of big sells coming through at this level. We might go down, or a lot of big buys coming in. Then there's also liquidity maps, and it's going to show where the buys and sells are sitting at in the market. If you got a lot of buy orders sitting at a level, the liquidity map is going to show you where all those buyers are sitting at. Same thing with sellers, where all those sell orders are sitting at. And then you move down further, there's delta, and I love using delta because delta is going to show you the amount of market buys versus market sells at a specific price, or a candle or level, however you want to interpret delta. I have a whole nother video on how you can interpret delta. There's a bunch of different ways to do it, but mainly it's just going to show you the difference in buys and sells at a level, and you can see what's going on real time. Are there a lot of buyers at this level? Are there a lot of sellers at this level? It'll show you real time what's going on. And again, watch some videos over it, really learn to understand it, and all of these things on this page right here. If you have a good understanding of all of those, you're already ahead of 90% of the traders out there. And two last tips before we move on to the next slide. The main one being, do statistics on everything. I can tell you that something's going to work, and some guy on the internet can tell you that something works, but you need to do your own statistics and understand Does it actually work? Is this guy just blowing smoke up my butt? Or does it actually work? Why does it work? And how much does it work? Do those statistics, because when you know the statistics on everything you're doing, you can better perfect your risk reward to be the most efficient and effective trader you can possibly be. And my other tip, something I'm fairly passionate about, is never purchase trading course, air quotation marks around trading course, from someone on the internet, unless they're showing you a multi-year proven, consistent, profitable P&L. And you'll notice a lot of them won't show you that because they probably don't have it. And there's going to be a lot of furus or fake gurus on the internet saying, hey, do this, buy my course, and you will make a lot of money. It's a bunch of malarkey. Everything you need on the internet to be successful is free. And 99% of those courses are just regurgitated garbage that they found on for free and just organized in some fashion and probably has no statistical benefit. Right? Now, there's a difference between buying a course and actually getting one-on-one mentorship from someone that you know is a proven profitable trader, right? You're paying them for direct one-on-one time. That's different. I'm just talking about the people like, hey, basically buy my slideshow, right? There's plenty of those online for free. In the Discord, we got a bunch of people in there that will tell you anything you need to know. You can Google almost everything you need. There's no reason to buy a course, especially when most of those courses are going to be taught by someone who's not even profitable themselves. It's a massive scam in this space. I just want you guys to be aware and don't waste your money on that. Like I say, look it up for free, or at least do a lot of research on whoever you're buying a course from if you are going to buy them. So yeah, that's the end of that rant. Now, the most important piece of information I can give you as a trader is to have patience. 90% of traders fail, but only 10% put in the effort to be successful. And why is that 10% only put in the effort to be successful? Because it's hard. It takes a lot of time. You're going to fail, you're going to lose money, and it's not going to make any sense for a long time. But if you continue to put in the work, do your time, do the research, do the statistics, and keep your emotions in check, you're going to notice success. Too many people come in and they just expect that it's going to be an easy, I'm just going to make 10 grand a day following this one guy's signals. Well, they fail. They blow accounts consistently, and then they get mad and they quit. You need to understand what you're doing and why you're doing it. And it takes time. The market is not consistent whatsoever. Every day, every week, every month, every news cycle, every presidential election, everything is different, right? So take the time to learn how to adapt to a changing market. Take the time to learn why the market is moving the way it is, and then just be consistent. Build yourself slowly and expect to fail. But every failure you take, learn from it, and you're going to be a good trader. Anyone can be a good trader if they really put their mind and effort into it. There's thousands and hundreds of thousands of successful traders out there. It's possible for anyone. You just have to be willing to put in the work and have the discipline to play the long game, to be good at it, because it's hard. Not easy. And if you don't want to put in the work, this is not the world for you, because the world of futures trading is brutal, and you will lose a lot of money if you're not willing to put in the work. If you would like to learn more about futures trading and see other people actually putting in the work as well, and learn from what they did, and talk to me on a regular basis, join our community. We have a Discord. It's 100% free. I don't sell anything. I really love futures trading. I love talking to you guys. I love doing this every day, and I just want to share with you guys how to do it. I want everyone to win, right? I want us all to do good and be successful, because this world is hard and it just doesn't need to be, right? So feel free to join our community, come chat, come hang out with real verified traders, and, you know, learn from some of the best. I'm not saying I'm the best, but there's a lot of really good people in here, a lot of really good educational content. I put a bunch of stuff on the channel, but there's a lot of other stuff in the Discord that other people post in there. So feel free to come join and hang out. And as always, thank you guys very much for watching all the way through the video. It means a lot to me, and I hope you guys learned a lot. If you have any thoughts, comments, or concerns, please leave them down in the description below. I reply to almost everything I see, and I love talking with you guys. And as always, also, this isn't financial advice. I'm just a goose. You know, if you go to your wife and say, oh my gosh, I lost $10,000 because this guy named Goose on the internet told me to take this trade, you're the idiot here. But I do hope that you found something helpful here, and I really appreciate you watching all the way through the video. If you could leave a like, I'd really appreciate it. And if not, I don't really care. I just do this for fun. I enjoy hanging out and talking with you guys. And yeah, we'll see you guys in the next one.